On a seemingly ordinary Thursday, a significant announcement rippled through the financial world, originating not from a scheduled press conference, but directly from the White House via a social media post. The message was concise, unexpected, and aimed squarely at one of the biggest pressure points in the American economy, the housing market. In a move that bypassed traditional channels, President Donald Trump declared he had instructed his representatives to initiate a massive financial maneuver. This wasn't a subtle policy adjustment whispered in the halls of the Treasury. It was a public proclamation designed to command attention and signal a dramatic intervention. The order was clear and direct. Purchase $200 billion worth of mortgage-backed securities, or MBS. To understand the gravity of this move, we first need to understand what these are. Essentially, MBS are financial products created by bundling thousands of individual home loans together. Banks sell these bundles to investors on the open market, which frees up their capital to issue new mortgages. The health of this market is directly linked to the rates offered to home buyers. The administration's strategy hinged on a fundamental principle of supply and demand. By injecting a colossal $200 billion buyer into the MBS market, the government would artificially skyrocket demand. When demand for a bond goes up, its price rises. And here's the crucial part. For bonds, as price goes up, the yield, or the effective interest rate it pays to the investor, goes down. This is the intended domino effect. As the guidance states, lower yields on MBS often translate into lower mortgage interest rates. Lenders who use these yields as a benchmark for their own pricing are incentivized and pressured by competition to pass those savings on to consumers in the form of cheaper home loans. The stated goal was unambiguous: to directly and forcefully influence the cost of borrowing for millions of Americans. This was aimed not only at those dreaming of owning a home, but also at current homeowners shouldering the burden of existing mortgage payments, who might soon find an opportunity to refinance. The president articulated his vision in a post that left little room for interpretation. This will drive mortgage rates down, monthly payments down, and make owning a home more affordable. The message was a masterclass in political communication, sidestepping the complex financial mechanics to focus entirely on the tangible, kitchen table benefits for the average citizen. By framing it as a pro-consumer initiative, the administration positioned itself as a champion for Main Street against the headwinds of a challenging economy. It was a direct intervention designed to provide palpable relief, a clear signal that the government was taking a hands-on approach to a problem felt by households across the country. This move didn't occur in a vacuum. It was part of a broader, multi-pronged strategy to tackle the housing affordability crisis. The administration had also been floating proposals to limit the ability of large institutional investors to purchase single-family homes, aiming to reduce competition for regular homebuyers. This $200 billion order was the financial muscle behind that policy agenda, designed to make individual buyers more competitive by lowering their cost of financing. But such a bold declaration, delivered with such abruptness, inevitably raised a storm of questions among policymakers, economists, and the public. The initial announcement was conspicuously light on details. Crucially, there was no specification of who the president's representatives were. Was it the Treasury Department? Or was he directing the government-sponsored enterprises, Fannie Mae and Freddie Mac, to use their own retained earnings? Furthermore, no timeline was given for how or when these massive purchases would occur. This ambiguity fueled intense speculation and uncertainty, leaving markets to guess the exact mechanics and timing of the intervention. This immediately led to a chorus of legal and financial experts questioning the president's authority. Could the executive branch unilaterally authorize such a colossal purchase without explicit approval from Congress? The move bore a resemblance to the Federal Reserve's quantitative easing programs, but with a critical difference. This directive was coming from the White House, not the independent central bank, raising profound questions about the separation of fiscal and monetary policy. Then, there was the sheer scale of the intervention. $200 billion is a staggering sum, difficult to contextualize. It's more than the annual GDP of many countries. This wasn't a minor market tweak, it was a financial bazooka aimed at the heart of the housing finance system, and it underscored the administration's seriousness. This represented a significant deployment of financial firepower, intended to fundamentally alter market dynamics in the most direct way possible. If the plan involved Fannie Mae and Freddie Mac using their own capital, it raised another set of concerns. These entities hold retained earnings as a buffer against financial losses. Using that capital for market intervention could potentially weaken their financial standing, leaving taxpayers on the hook if the housing market were to take another downturn. Regardless of the unanswered questions, the sheer size of the number guaranteed it would not be ignored. The announcement sent an immediate shockwave through the markets. Investors, lenders, and millions of potential homebuyers were forced to sit up and take notice. Traders began pricing in the expected impact, and the effects were almost instantaneous. The stage was now set for a major new chapter in American housing policy. It was a chapter that promised immediate, tangible impact for consumers, but one that was shrouded in critical questions about its implementation, its legality, and its potential long-term consequences for the stability of the financial system. The promise was clear, but the path forward was anything but. To understand the potential impact of the president's recent order on the housing market, we must first unpack a complex but crucial financial instrument, the mortgage-backed security, or MBS. These securities form the bedrock of the American mortgage system, acting as a vital bridge between the global financial markets and the individual homebuyer on Main Street. While the name might sound intimidating, the concept is a cornerstone of modern housing finance. It's a system designed to keep money flowing, enabling lenders to continuously offer mortgages to new buyers. Without MBS, the ability for millions of Americans to secure home loans would be drastically different. So, let's break down exactly how this intricate process works, step by step, to see how a policy decision in Washington can directly influence the interest rate you're offered on a home loan. The journey begins at a familiar place, a local bank, credit union, or mortgage lender. A prospective homebuyer applies for and is granted a loan to purchase a property. This loan is a contract, an asset for the lender, representing a future stream of income from the borrower's monthly payments of principal and interest. In the early days of banking, a lender would hold this loan on its own books for its entire term, perhaps 15 or 30 years, slowly collecting the payments. This model, however, had a significant limitation. The lender's capital was tied up for decades, restricting its ability to issue new loans to other aspiring homeowners. To solve this capital constraint, the process of securitization was developed. Instead of holding on to a single mortgage, the original lender gathers hundreds or even thousands of similar individual mortgages. These loans are carefully grouped together based on shared characteristics, such as loan type, interest rate, and borrower credit quality, forming a large, diversified pool. This bundling is a critical step. It spreads the risk. The chance of any single homeowner defaulting on their loan is mitigated by the reliable payments coming from all the other homeowners in the same pool. This diversification makes the entire package more predictable and therefore more attractive to outside investors. This newly formed pool of mortgages is then sold. The buyers are typically large financial institutions, like major investment banks, or more commonly, one of two government-sponsored enterprises, known as Fannie Mae and Freddie Mac. These entities play a central role in the U.S. housing finance system. By purchasing these mortgage pools from the original lenders, they inject immediate cash back into the system. This transaction is the key that unlocks liquidity. The local bank now has its capital return, ready to be deployed to fund the next wave of home loans, keeping the gears of the mortgage market turning smoothly. Once Fannie Mae, Freddie Mac, or an investment bank acquires the pool, they perform the final step of securitization. They slice this large pool into standardized, tradable shares, much like shares of a company's stock. These shares are then packaged and sold to investors on the open market as bonds. This is the birth of the mortgage-backed security. Investors, ranging from large pension funds and insurance companies to foreign governments and individual retirement accounts, can now buy these MBS bonds. For these investors, an MBS represents a claim on the cash flow from the underlying mortgages. As the original homeowners diligently make their monthly mortgage payments, that money, both the principal and the interest, doesn't stop at the local bank. Instead, it flows through the system, passing through the mortgage pool and getting distributed to the investors who hold the MBS bonds, proportional to their share. In essence, the investors have taken the lender's place, receiving a steady income stream from thousands of homeowners across the country. This creates a vast and active secondary market where MBS are bought and sold daily. Like any traded asset, their prices are determined by the fundamental laws of supply and demand. When many investors want to buy MBS, demand is high, and the price of the bond goes up. Here, we encounter a crucial inverse relationship that is central to understanding mortgage rates. For a bond, its yield is the effective rate of return it provides to the investor. When the price of an MBS bond goes up, its fixed interest payments represent a smaller percentage of that higher price. Therefore, its yield goes down. Conversely, if demand for MBS falls and prices drop, the yield for a new buyer goes up. This relationship is the linchpin connecting Wall Street to your mortgage application. The yield on these widely traded mortgage-backed securities serves as a primary benchmark that lenders use to set the interest rates they offer to consumers. When MBS yields are low, lenders can acquire capital more cheaply on the secondary market, and they pass those savings on to borrowers in the form of lower mortgage rates. When MBS yields rise, the cost of capital for lenders increases, and mortgage rates for homebuyers follow suit. Because of this direct link, the 30-year fixed mortgage rates quoted by lenders are inextricably tied to the daily conditions in this MBS secondary market. A lender isn't just thinking about the money they are lending you, they are constantly watching the MBS market to determine the price at which they can sell your future loan. This entire ecosystem is highly sensitive to external forces. Major economic data releases, shifts in Federal Reserve policy, or a massive government purchase program can dramatically alter the supply and demand dynamics for MBS, causing their prices and yields, and consequently, consumer mortgage rates, to move very quickly. This intricate connection between government policy, investor demand, and homeowner costs is precisely what the White House aims to leverage with its new directive. By intervening in the MBS market, the administration intends to directly influence the chain of events we've just described, with the ultimate goal of affecting the rates available to millions of American homebuyers and homeowners. The core logic is classic supply and demand. Inject a massive new source of demand into MBS, prices rise. As bond prices rise, yields fall, the benchmark drops. Lower MBS yields translate to lower mortgage rates for consumers. The plan makes bonds more expensive for investors, cheaper mortgages for buyers. Imagine a new bidder with 200 B-dollars, prices jump, yields compress. Lenders tracking benchmarks adjust pricing in near real time. TD Cowen. Full 200B could lower 30-year rates from over 6.2% to roughly 5.25%. Others, a 10 to 25 BPS drop, nudging averages toward over 6.0%. Mechanically similar to QE, but different origin and justification. Instead of an independent monetary tool, this is an executive branch fiscal deployment aimed squarely at housing relief. Goal: lower financing costs to ease access to home ownership. To understand the shockwave that hit the housing market, you first have to understand the mechanics. When a major player decides to buy up a vast amount of mortgage-backed securities, or MBS, it dramatically increases demand for them. Basic economics tells us that when demand for an asset goes up, its price follows. For bonds, including MBS, price and yield have an inverse relationship. As the price of these securities is pushed higher, their effective yield, or the return an investor gets, is pushed lower. This is the crucial link. The yields on these benchmark mortgage bonds are a primary driver for the interest rates lenders offer to home buyers. So, when MBS yields fall, that saving is passed through, resulting in lower mortgage rates for everyday people. The question was, who had the power and the capital to make such a move? The buyers, Fannie Mae and Freddie Mac. These are the government-sponsored enterprises, or GSEs, that sit at the absolute center of the U.S. housing finance system. Since the financial crisis of 2008, both have been operating under a conservatorship managed by their regulator, the Federal Housing Finance Agency, or FHFA. This unique status gives the federal government significant influence over their operations, and the directive came straight from the top. In a statement that caught many by surprise, FHFA Director Bill Pulte affirmed the plan with confidence. "We are on it. Thanks to President Trump, Fannie and Freddie will be executing." This wasn't just a suggestion, it was a clear signal of a major policy intervention, framed as a direct move to address housing affordability. The action was immediate. "We put in a $3 billion buy already," Pulte announced, confirming that this wasn't a future plan but a present reality. This initial purchase was just the opening salvo, a first step toward a much larger headline-grabbing figure, a potential $200 billion in total MBS purchases. A critical detail was the funding source. President Trump clarified that these massive purchases would be financed using the GSE's own cash reserves, not through new federal spending or taxpayer money. This was a key distinction from the Federal Reserve's quantitative easing programs, which involve creating new central bank reserves to buy assets. Here the plan was to use the enterprise's accumulated profits. As Trump explained his rationale, "Because I chose not to sell Fannie Mae and Freddie Mac, it is now worth many times that amount, and has $200 billion in cash." The statement positioned the GSE's massive cash pile, built up over years of profitability under government control, as a strategic asset ready to be deployed. However, using retained earnings for large-scale market interventions is a deeply complex and controversial move. Those reserves aren't just idle cash, they exist for a crucial reason: to act as a capital buffer to absorb potential losses in a severe housing downturn, protecting taxpayers from another bailout. Deploying a significant portion of that capital to buy MBS inherently reduces that safety cushion. This immediately raised red flags for regulators, economists, and market critics, who warned that it could leave the GSEs, and by extension the taxpayer, more vulnerable. They would be watching every move with intense scrutiny. Beyond the financial risk, the legal authority question remained contentious. The scope of the FHFA's power under the conservatorship has long been debated. Using that authority for such a direct market intervention, rather than for preserving the safety and soundness of the enterprises, was bound to invite potential legal challenges. The announced intent was crystal clear: lower mortgage rates. But the execution details, the timeline, the pace of purchases, and the strategy for eventually unwinding this massive position without disrupting the market were not. This ambiguity created its own form of risk. But the financial markets don't wait for all the details. Traders and algorithms move in seconds. Markets began pricing in the impact of the directive immediately, anticipating a fire hose of demand for mortgage-backed securities. The effect on consumers was almost instantaneous. The average rate on a 30-year fixed mortgage, which stood at 6.21%, fell sharply to 5.99% by the very next morning. It was the first time the average had dipped below 6% in over a year, reaching its lowest point since February of 2023. Wall Street placed its bets immediately. Stocks of major mortgage lenders surged on the expectation of a boom in new loans and refinancing. Rocket Mortgage jumped 9% to a high not seen since 2021. Its rival UWM soared 13%, and Fannie Mac Financial climbed 6%. The market was betting that lower rates would unlock a wave of profitable activity. For prospective homebuyers, the impact was tangible. Real estate brokerage Redfin calculated that a buyer's purchasing power had already increased by about $30,000 over the previous 6 months as rates had slowly softened, and this announcement dramatically accelerated that trend. Let's look at the math. For a buyer with a strict monthly budget of $3,000 for principal and interest, this rate drop meant they could now afford a home worth around $479,750. Just a month prior, that same payment would have only qualified them for a loan on a $466,000 home. That's nearly $14,000 in extra buying power, unlocked overnight. A wave of optimism surged through the housing sector. For the first time in a long while, a powerful force was actively pushing rates down, offering immediate relief to buyers. But while the short-term benefits were clear, the long-term sustainability of this intervention and its unintended consequences remained a very open question. Analysts and economists broadly agree. 200 bite of MBS buying pushes rates down. Debate centers on how much and for how long. J.P. Morgan. 200B is only the 1.4% of the 14.5T mortgage market. Effects may be marginal. Some optimistic calls approach 1.0%. Many expect 1025 BPs. Helpful, not dramatic. Fed policy, inflation, and growth could overwhelm MBS pressure, leaving long-term rates uncertain. The 200B directive pairs with a proposal to ban large institutional buyers of single-family homes. Rationale: corporate purchases convert homes to rentals, reduce for-sale supply, and outbid families with cash. Goal: reduce competition for owner-occupants and rebalance the market. A holistic push: cheaper financing plus reserving more homes for buyers, not institutions. Officials cite 30-50 strategies queued: More announcements expected in the weeks ahead. The administration is mounting a full-court press, signaling housing affordability as a top-tier priority this year. Strategy intent: tilt conditions toward aspiring American homeowners. Significant risks and unanswered questions remain. Using 200B in retained earnings could weaken capital buffers at Fannie and Freddie. Critics warn of GSE vulnerability and taxpayer exposure in a downturn. Authority ambiguities could invite legal challenges and delays. Lower rates can spur demand and price gains, potentially erasing affordability benefits. A government-sized buyer risks distorting signals and fostering dependence. Open question: how and when do GSEs unwind positions without disrupting markets? Even a short-term boost can have complex aftereffects for years. For today's homebuyer, opportunity mixes with uncertainty. Monitor daily rates, shop multiple lenders, and consider locking favorable dips. Moves can reverse due to legal hurdles, slow rollout, or negative economic news. Be prepared for competition. Lower rates don't equal easy buys. Stay informed via FHFA updates and market data. Combine diligence, patience, and strategy.